to another Wednesdays with IGTB. This time we have a great topic. It's contextual virtual accounts. Virtual accounts have come a long way. They are now something the corporation can decide where they want to put the money in, instead of having to use accounts that are regulated and for the convenience of the bank. Anyway, enough of me. I want to introduce my wonderful guests today. So the first is Varun Yadav. Varun is Principal of Treasury Services at Bank of New York Mellon, part of the Global Innovation Programme. He's had a long career in banking, focusing especially on liquidity. He's based in London and from the ACT has a certificate in international cash management. On the other side of the Atlantic, pleased also to have Michael Suter. Michael's an independent, but was until fairly recently the head of liquidity at Santander US. He's had 25 years plus in cash management, working in large and global banks, and he's based in Columbus, Ohio. And from the AFP, he also is a certified treasury professional. Both Varun and Michael have a lot of experience working with corporations of all different sizes and styles and industries. The third guest is Balakrishnan Narasimhan. Bala has been a banker, has been a consultant with Deloitte, and has spent much of his career providing solutions in software to banks to help with cash management. He is currently the head of solutions for US and North America for Intellect Global Transaction Banking, IGTB. So without further ado, I'd like to hand over to Balakrishnan to speak to Varun and Michael and discuss this wonderful topic. Just to point out, please do ask questions. Simply hit the Q&A button on your screen and you can ask a question. We will take questions, we will respond to questions at the end, but you can ask them at any time. Bala.
Very good morning, Michael, and good afternoon, Varun. Welcome to the session on virtual accounts and the contextuality of virtual accounts in today's world. So as Phil was illustrating earlier on, we are hearing a good lot about virtual accounts in recent times. Quite often what we're seeing is there's a lot of ecosystem demands, and corporate clients have been trying to solve a variety of problems using a lot of innovative and creative solutions. We're also seeing regulations playing some bit of a role in terms of defining and changing the landscape of cash management in general. And last but not the least, a lot of institutions looking at operational and technological challenges that they want to address. The last 6 months of going through an international pandemic has also added to this whole scenario, creating a need for a variety of creative and innovative solutions. So we are clearly aware, we're seeing a lot of trend in the market, a buzz around what virtual accounts really are. One of the first areas and of significant interest to me personally is why exactly is this trend that is coming out of the market? Now, I've seen personally that this evolved over a period of time. Virtual accounts is not necessarily a new concept. It's been existing in some form or the other over many, many years. It's just become a lot more crystallized in recent times. So given that aspect, let me start by asking Varun, what do you think, Varun? How exactly do you think your clients are looking at virtual accounts as a method to contextualize cash management in their financial life cycle? What's your viewpoint on that?
So yes, thanks, Wala. And I think the way in which the clients are looking at virtual accounts is not very different from the way in which I think we as banks also see the main strength in virtual accounts. And the main strength of the virtual account, I think, at the core and the heart of it is its flexibility. So basically the ability to open a virtual account structure and create a structure which is able to track and manage payables, receivables, liquidity, cash segregation at any level. So, whether to the point that you said, corporate segregation from an individual subsidiary level, all the way down to client and supplier level, and down to the very, 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 very root level of where you can actually track virtual accounts at invoice levels themselves. So I think that ability to actually contextualize your account structure according to your cash flows and according to your business needs basically is what actually makes it pretty attractive to our clients. I think that aside from the fact that the concept itself is old, but the technology developments are slightly more new and have those favorable winds behind it. They are traditionally been very attractive to large multinational corporates. So traditionally you would have thought there needs to be a certain volume of transactions and a certain value of cash that needs to move between virtual accounts to actually make it worthwhile for a client or corporate clients to actually invest their money in, and also a bank to actually invest that in. But I think now it's getting a little bit more of a level playing field where you can actually make it viably accessible across various sectors and across various size of corporates.
Excellent. So thanks, Varun. That's a very interesting point that you bring out, because one of the things that you mentioned was more specifically around large multinational companies. While I have also heard a lot of instances where the current scenario, especially with respect to cash visibility and creating working capital requirements, especially more so in the segment of small businesses and mid-market clients, is also generating a lot of interest. Michael, I think you may have some views on that, especially given the conversations we have had in the past, and we're seeing a lot of buzz around this in the United States and Canada. So what do you feel about that, Mike?
Yeah, so I think there are a couple of things, right? Certainly as Varun identified, one of the top priorities for really institutions of all sizes is really around cash flow forecasting, cash positioning, really understanding what that forecasting is. And anytime you can get greater insight around that, that's a high value to deliver to that ultimate client. I think, Bala, to your question around, within different segments, certainly things that have bubbled up, from the work that I have done is around sort of that escrow community where folks that need segregated accounts. One of the top priorities for clients that have escrow situations is that they want to be able to easily open and close accounts, have control of those accounts. I think Phil kind of referenced that a little bit earlier when he talked about putting the power of account structures into the hands of clients. That's what a virtual account will allow them to do, as opposed to being very dependent upon the bank to have those bank structures or have the account structures in place.
That's very interesting, Michael. So, what would you see in terms of what does it really mean for a bank from a benefit standpoint? What do they get out of this game? Is this something that's generating an interest from a revenue opportunity standpoint, or is it something to do with the whole concept of generating deposits? What really a bank looking at? And in addition to the couple of points that you and Varun mentioned earlier, what really is the intrinsic benefit to the corporate clients as well?
Yeah, so I think there are a couple of things there, and they're kind of inextricable, but certainly if you're able to deliver some capability for clients that don't have them, again, we use that example of escrow, that obviously opens new markets for you, and it allows you to better position new solutions with clients to attract that type of deposit, which is one of the more coveted deposits that banks seek, right? A low cost deposit on their books makes it very friendly for bank funding. I think the other thing is when you talk about the capabilities of delivering insights to that client, that really moves a bank's positioning up toward primacy with that client. And if you're the prime bank or the concentration bank with a client, typically you get 3-4 times the amount of fee revenue from those clients, and typically the overwhelming majority of low-cost deposits. So those are two enormous benefits that a bank would receive by basically being able to offer virtual accounts, creating those greater insights and around that client's business, and really strengthening that partnership.
Excellent. Thank you, Michael. Warren, how different is it from your perspective? I mean, you see this interaction happening in a lot of other global countries in addition to North America. Is that perception on benefits a little different in the rest of the world?
I think not necessarily. I think especially given in the current status, in the ultra low interest rate environment that we are in, and the requirements now that the new requirements that require us to as banks to hold operational deposits with our clients. I think virtual accounts, the attraction for banks, irrespective of the size, I suppose, is that it allows you to get a little bit closer to the client and offer them solutions that ensures that you're able to increase your operational deposits and the size of your book, essentially, which is very, very meaningful in the current state that we are in terms of the interest rate environment. And I think secondly, the point that Michael made is actually equally relevant. I think the main attraction also from a revenue perspective for the bank is on the fee income that we can generate from it. So a virtual account structure that actually works for a client would actually be able to actually help us generate payments which are or volumes which are more favorable and drive the overall revenue in that sense. I think those are the things. I think in Europe compared to the US and Canada, virtual accounts have been around for a lot longer, and I think the underlying benefit that the banks also see, apart from the clients, also a host of benefits that the clients get from virtual accounts, is that it improves the overall quality of relationship between the bank and the corporate. So it just helps make it more sticky, helps turn it into a more longer term partnership. It's also a partnership and a relationship which is built more on value rather than kind of the transactional nature of just doing the normal payments or clearing and so on. So I think that's the thing that's also very, very attractive for banks.
Oh, excellent point, Varun, because I see a lot of bankers very commonly using the term becoming a primary banker for their customers. I think the point that you made is exactly in that line as well. So great conversation. See, one thing that's clear in my mind, at least after this conversation, is one, in terms of client segment, banks, clients, corporate client segments, cash visibility is simply the key focus. It's really agnostic of client segments. It's one of the first observations I have. The whole aspect of reducing the landscape of physical cash accounts, the aspect of automated reconciliation of payments and receivables is simply not something that is a luxury that is intended for large corporates, but it's very clearly evident it's spanning across the section. And one of the key areas, and that's where we'll probably move on to the second topic, is something of very deep interest these days is real-time payments. What really caught on as a great innovation in the last many years in markets like Asia, Southeast Asia especially, Asia Pacific to a good extent, and Europe as well. In the last few years, the US and Canada have been putting in a lot of effort to enhancing their real-time payments infrastructure with the RTR through the Payments Canada framework coming out in Canada, and the TCH launching the RTP product a while back, which is gaining a lot of prominence. Now, there's obviously a very, very fine line connecting the dots between the concept of virtual accounts and the concept of real-time payment. Simply, we're seeing a lot of banks trying to really leverage this whole innovation to see what it does for their customers. So, from your perspective, Varun, so what do you think is really influencing, or what is a factor that's driving virtual accounts as an adapter by using real-time payments as a leverage?
So I think the points that you made about the prominence of real-time payments. I mean, in the current digital economy and the current everything's instant. So you can't underestimate how much more prominent real-time payments will eventually get. We are not there in the US, absolutely, but we'll get there very much like we have in the other parts of the world. But I think from a corporate treasury perspective, real-time payments and the associated narrow clearing cycles, they actually come with their own set of challenges for the corporate treasurer. So the more and more mainstream real-time payments are going to get, as soon as the transaction limits start going up, as soon as the adoption rates start going up, those challenges are going to get more and more sizable. And the challenge really is basically, real-time payments necessitate real-time liquidity. So, there are opportunities over here, obviously, where a corporate treasurer is able to get a real-time view into their cash. They would be able to, make their working capital buffer much more efficient. They would be able to unlock the cash. They would be able to, meaningfully manage their short-term borrowing requirements as well. And what the impact of the virtual accounts in this particular space would be to kind of help them get there. The far end of this particular space in terms of real-time liquidity, and people often talk about it. I don't think we are there right now. Is where in the future, in terms of both short-term investing as well as borrowing, so your funding as well as your investing requirements, the instruments will cease to be instruments which calculate interest on a daily basis or a weekly basis or a monthly basis. You'll have interest which you calculate on a minute by minute basis or on the basis of an hour and so intraday and real time. And I think while that is very far away at the moment, what we would be able to get from virtual accounts is their ability to do real-time allocation, real-time reconciliation of the cash. And that basically relates into real-time view of where your cash is, real-time information, real-time reporting, and basically the ability for a client to actually manage their cash on an intraday and a real-time basis. I think very shortly, and again depends on how quickly we adopt real-time payments, we would be in a place where end of the day management of doing a zero balance on your liquidity structure or sweep structure or managing target balances. I don't think that would that will stay for forever. That will be replaced by requirements on real-time liquidity, which is where these capabilities of virtual accounts become very, very meaningful and useful.
Well, that's a very interesting set of use cases, Varun, and I'm pretty sure, especially more so in Europe, there's a lot of demand in terms of cross-border, cross-currency scenarios as well, cross-country obviously included, where these kind of real-time positions and viewing cash positions and taking advantage of cash positions is probably going to be of significant importance, right?
Absolutely. So especially in the with the advent of SEPA in Europe, especially the push towards your shared service centers and the entire infrastructures on POBO, COBO, and in-house banks actually got kind of a new wind, and banks started actually setting up these complex structures at that particular point to manage a lot of their cross-border payables and receivables, and those things are extremely complex. They are extremely tricky to set up. They require a lot of investment to set up. In the current setups, it's also not without errors. Where you have incoming foreign currency receipts. Whether you apply them to the relevant subsidiary account or not in an in-house bank structure. It will all depend on how well the sender actually constructed their payment before they send into you. So those problems kind of, they don't go away absolutely entirely in their own, but they get very, very, very much more efficient once you basically apply virtual accounts, right? You're given a virtual account, unique virtual account to each client, and then you track the payment on the basis of those virtual accounts. So absolutely. I mean, that is the model which has kind of permeated itself throughout Europe, all the way from large corporates down to kind of if you go to a car rental company, there's a big likelihood that they might be using virtual accounts.
That's very true. That's very true. And what you just mentioned brings me to an interesting segue to what's happening into this whole small and medium market segment. And one thing that I have been observing is the relevance in today's environment of something like DSO. And the visibility into DSO and using that DSO position to make a lot of cash position decisions. Like, for example, am I at a point where I can make payments in the next 3 days, for example? I'm talking about small businesses here. Am I in a position where I've got some excess cash that I can invest overnight into some instrument that can give me a better benefit? Now this whole mindset and the paradigm around what does that investable money or what does that cash liquidity mean to me changes. Michael, on this side of the pond, what do you think is happening out here, especially with COVID around and also with small businesses and whole segment that banks are interested in, with real-time payments providing low risk, low transaction limit kind of an environment with RTP? What do you think that's going to take us to?
If you think about some of the businesses today and how real time is being adopted, certainly it's seen greater adoption in Europe, but there is probably, it's starting to get some stronger adoption, particularly on the smaller end of the segments. Look, clients need cash. You mentioned day sales outstanding or DSO. Any opportunity they have to reduce that is a real impact to an organization. I like to think about an example of if I had a tree cutting business and I had a couple of teams out cutting trees, right? If I was able to leverage, and this is where it's evolving, right? If I was able to leverage real-time payments for like a request for payment, I could have my first team out and complete a job, and they could take a picture showing that they cut down the tree, hopefully the right tree, not the neighbor's tree, right? And they could send that to the client and receive that real-time payment. But I could have 3 or 4 other teams out in different communities doing the same thing. In that, I could marry in a virtual account structure. And, within that, I could start to get some insights about my business and understand that, look, team A, they operate here. They seem to get a bigger take. They seem to get more jobs. They seem to, folks are engaging with the real-time payments a little bit better. Team B, maybe it allows me to have insight around my geography and footprint and business that it allows me to maybe be more effective in how I deploy my resources and generate revenue for my organization. So I think that's going to be a part of the power proposition too, on what it's going to unlock for smaller businesses where they don't have a lot of treasury infrastructure, they don't have a lot of reporting infrastructure, but they could still get very important insights by leveraging a virtual account platform. And you put that in combination with real-time activity, I think they're really going to see some power out of that.
Well, I think it's very interesting times that we live in right now, Michael and Varun, because see, just by virtue of the examples that you guys gave or the use cases you're talking about, the variety of banking clients that is going to influence is significant. I know the use cases are enormous, and there's a whole lot of impact that this is having across various client segments. The banks are impacted, like you rightly said, in terms of newer propositions. So simply put in a simple phrase, I can personally state that this is literally redefining the landscape of what the cash management playbook was all about in all these years. And virtual accounts is clearly leading the way into that. So one of the other things that I want to quickly touch base on is a point that Varun also mentioned or he alluded to a little while back. As to what's really happening between the cross-section of virtual accounts and liquidity. There seems to be an obvious set of overlaps out here. Now, straight reaction, as a person who's been talking to a lot of people in this region in North America, one of the things that comes out is a lot of bankers seem to think that virtual accounts is probably going to provide a literal alternative to cash concentration as we used to know it. So let me kind of take your thoughts on that, Varun and Michael. So to start with Varun, since you actually brought up this topic earlier as well, so I want to kind of leverage your thoughts and continue on that conversation. And I know Michael also has some viewpoints around this. So what's really happening in that side? Is something like virtual account literally an alternative, or is it an overlap? What's really happening there, Varun?
So I think, you earlier made a point, Bala, which is that, virtual accounts are not a new concept, and that's absolutely true. They've been around, especially in the Nordics for a very long time. There's a concept called Nordic cash pooling, which is very much present and prevalent in the region, and essentially it works as a in-house bank concept, except for managing liquidity. Now it's is it completely an alternative to the traditional liquidity tools? That you might be able to question that, though. I think virtual accounts are often pitched as a very viable alternative to notional pooling. Notional pooling is not, as you could say, viable as it was before from a revenue perspective, and just management perspective, and virtual accounts are often discussed, and it's discussed whether they can, by means of something like a Nordic cash pool, they can be an alternative to notional pooling, as well as just traditional cash concentration. There's a natural concentration of cash into a very rationalized, sometimes probably even, theoretically even a single physical account per currency as itself. So that natural concentration of cash, backed by this virtual sub-accounting ledger that hangs at the back of it, gives all the benefits that you would think that you would get typically from a traditional account structure, with the sweep rules and the pooling rules all set up into it. So that is absolutely, I think, a possibility, and I think it's a possibility worth examining and worth exploring for kind of the wider clientele and the wider corporate base across the world, because the ability essentially for a corporate to be able to manage a single pot of cash at a group level, and then have individual credit limits on a virtual basis for individual subsidiaries, and manage the same kind of sweeping rules that they do, zero balancing of sweeping rules that they do typically on a traditional physical account structure, which comes with its own costs and so on. Managing all of that through a virtual account structure in Nordic Cash Pool actually is viable, and certainly should be of interest to a lot of corporates.
Very interesting, and actually, it's a very interesting point you bring about self-concentrating or automatically concentrating account. And Michael, you mentioned a point once about the cost of maintaining bank accounts, right? So where I'm getting a little excited about the thought of slightly larger. We're not talking about small businesses here. We're talking about businesses which probably have maybe about 30, 40 accounts on the average across various locations. And now with these guys, every time you open a new bank account, the amount of time it takes to onboard a physical account with the bank, I guess, and that's where I'm going to pick your brains on. It's, I guess, the time it takes to open that new account, given the whole process that it goes through in the United States, for example, the whole time aspect, the cost of maintaining this account. Maybe there's something there that's actually linking this connection back to liquidity and saying that virtual accounts is really helping banks and their clients significantly reduce their operational costs as well. So what do you think of that aspect? And in general, Michael, the whole proliferation of virtual accounts into the liquidity management space?
Yeah, so you made the point about infrastructure. When you have a lot of accounts that are being opened and closed, right? So that while the banks often charge fees for some of that process, the bank still has to maintain a back office that does a lot of that work. A lot of it's manually and time intensive. And so if there's some efficiency created from virtual accounts, or reduce that, as opposed to passing on quote unquote operational costs, again, the bank is now charging for insights and value and information, which is more important. It's higher return for the bank, and it's certainly higher return for the client. I think that and Varun touched on this a bit. When you think about how virtual accounts, we in sort of the transaction banking business have talked about frictionless a lot as a bit of a mantra in the industry. And one of the things that virtual accounts does is takes us a step there, where if you have the money, stored predominantly in a single account, you don't have to worry about the time lags associated with concentration, right? You can be very efficient. Talk about cash positioning. Again, that cash forecasting, very important to all businesses, large and small. Knowing you have a greater certainty of what those positions are, and you don't have to have as much sitting in a target balance. You're creating a lot of efficiency in your cash operations. And I think that's a power that's going to really be embraced by all the businesses with that level of efficiency and less friction in the system. I know what my balances are. They're more predictable, and I can invest more efficiently.
So awesome. That really speaks to the power of what virtual accounts can do, not just in terms of providing benefits to banks, but to their customers as well. And in summary, what I can clearly see is, when we look at reimagining the space of liquidity as we know it, it's simply, again, bringing back, at the risk of repeating a point I make over and over again, it's not really about each client segment. It spans across a variety of customer segments, a variety of banks. So the bottom line of it is we're simply looking at a new mechanism that is reshaping a subset of cash management, which is liquidity management, and actually bringing out, like I said earlier, a redefinition of the playbook for transaction banking and cash management.
So I just want to remind everybody that the Wednesdays with IGTB series is at igtb.com/Wednesdays. We've got quite a few earlier discussions on cash management on there already, with guest speakers from Nordea, Santander UK, from Intesa, HSBC, Abu Dhabi Islamic Bank, Arab National Bank, as well as companies like Microsoft, Capgemini, IT, Red Hat. And obviously the recording of this webinar will be put on that as well. I've put my question master hat on because I wanted to make sure we got some good questions. Also, it's our annual Intellect Festival today, so as part of Intellect Global Transaction Banking, we're having a bit of fun. Let me kick off with an interesting question came in about escrow. There seem to be dedicated systems, maybe quite narrow systems there for escrow. Bala, what's the position of escrow systems as against using virtual accounts?
That's actually a pretty interesting and a very good question, Phil. I guess the timing could not really be more perfect, in today's scenario. Yes, there are specific and dedicated solutions, and that's exactly what they are. I would call them highly myopic. And let me explain. Let me kind of illustrate what I mean by that. So me and my team at IGTB, we've been talking to a lot of banks on this exact topic, especially more so in North America. Note that these are the banks that are trying very hard to address the exact issue or desire that Michael alluded to earlier when he was referring to the escrow use cases. And that's essentially, increasing the deposit base for the bank, providing self-service and flexible account segregation, and increasing fee revenue opportunities for the bank. As many folks in the market already know, we at IGTB provide a very comprehensive solution to handle a wide cross-section of use cases, including corporate virtual accounts and client money management, of which escrow is a subset. In almost every one of the conversations that I've had with banks that are evaluating this option in North America, I find that they're very, very pleasantly surprised when I tell them that the exact same framework that provides the virtual account capability can also support escrow accounts under the broader banner of client money management. Now, why exactly is this significant? In my view, there are probably two reasons. One, these banks are realizing that they can now roll out escrow as a use case to solve immediate and urgent business needs. But more importantly, they can leverage the exact same foundation layer that I've already purchased and extend it to corporate virtual account, receivables management, payables reconciliation, in-house banking, liquidity management, all the use cases that we've spoken about. And the whole idea is, the incremental cost is literally minimal to almost nothing because you're using the same foundation. The second aspect is the self-service part. Varun and Michael also alluded about it a little bit earlier. The demand for a state-of-the-art, multi-channel solution, multiple devices, which is also of a high demand in today's world of consumerizing the corporate banking world. What we're hearing from the banks that we're talking to, this is something that they're finding lacking in many of the older solutions, the pointed solutions in the market. So bottom line being, the desire is not just to replace an escrow deposit platform, which is a narrow and a short-term objective. The banks that I've been talking to are clearly seeing that the real benefit is to have one platform that helps them address a wide variety of use cases for a broader range of virtual accounts, and it is more long-term focused.
Right. We've had a number of questions in around KYC and AML. I've got to get this right. I'm struggling with my initials. KYC and AML. One of them is really saying, do you think corporate virtual accounts could be opened under a physical bank nostro? Are there any AML or KYC ramifications? And then how are KYC and AML risks managed in virtual accounts management as you allow the customer to open the accounts? I mean, I'm assuming that the processes are much less onerous than regulated accounts, but that there's still a process to be gone through. I think Varun, as perhaps from a large American bank, perhaps you could comment on what happens there in terms of the regulatory issues.
So you're correct, Phil. There is an amount of effort that's still needed. So your KYC, AML obligations and requirements simply don't go away just because you're replacing a physical account with a set of virtual accounts. It's less onerous. But there's also, from what we've seen so far, there's not a single standard by which all banks operate. So different banks have different KYC, AML policies, different appetites for risk. I think from what we've seen, there's a full spectrum of KYC and AML policies in regard to virtual accounts. Some banks would be very, very KYC light in that sense, which is once they've opened a particular physical account for a particular legal entity, everything that opens underneath that is in terms of a sub-accounting ledger is linked to the physical bank accounts, and so should not need any additional KYC. Going down to slightly KYC light, which is there's some oversight which is provided by the bank in terms of opening virtual accounts and kind of what currencies are you opening those in, kind of what's the number rate and kind of what's the purpose of those, and then when eventually kind of the I guess in some cases also the full KYC AML, which is there is a certain degree of self-service which is still afforded and available to the clients to self-serve and open their virtual accounts, but with a still a certain rigor on KYC and AML perspective from the compliance department. So I think there's not one particular standard that has emerged so far. There's a whole full spectrum of it, and I think that's there'd probably be a point in time in the future where they will start merging a little bit, and things will start probably come to the middle somewhere where KYC light kind of becomes the norm. But right now, kind of there's a whole host of variations around it.
Very, very valid point, Varun. Also, a lot of people that I speak to think that virtual accounts will literally eliminate KYC from a bank's perspective, but that's not entirely true. It's like it reduces it to a certain extent. There's an element of responsibility that moves to the corporate, but the bank is still owning the primary customer, the primary physical real account, right? So that relationship and that ownership still exists. That's a good point. Yeah.
Thanks very much. I'm going to bring Michael in on a question that I have to say is applicable in every webinar I've been in and every meeting I've been in, whether it's on virtual accounts or anything else, which is What about costs? What about reducing costs, reducing operational costs or cutting costs in other ways? How does virtual accounts help? Michael, what's your view? And then perhaps we'll
it depends on the view that, are you looking at it from a bank view or from an ultimate client view? But in both cases, I think the answer can be yes. When you think about from the ultimate client view, as we just sort of established, the virtual accounts are associated with the physical accounts, but you aren't necessarily opening and closing those physical accounts. And the ability for the client to do that takes a lot of that operational burden off of the banks. So typically you would think the bank would be passing along the lower cost of having a virtual account versus a physical account, and the client then could have a lot more accounts at a reduced cost. And then when you think about the bank, as I mentioned, the lack of the need to open and close physical accounts on behalf of that client, that obviously reduces dependency upon that operational infrastructure. So there's efficiency that would be created by the virtual accounts, and it should result in lower costs for both the client and the bank.
But I mean, you and I maybe slightly have a slightly biased opinion here, but usually, you know, you're looking at how we can introduce systems and so on. So what's the position on cutting costs in virtual accounts from your perspective?
So part of what Varun and Michael also spoke about earlier, right? See, there's two angles to it, and the more and more I observe the cost element of it, especially operational cost element of it, it's very, very significant from a corporate treasurer perspective. On one side, these guys are trying to improve treasury operations. They're trying to centralize cash position. They're trying to provide increased focus to a sub-entity level data for bank accounts. They want to get a realistic view of cash position that is actually aligned to the corporate book. They have, many of these corporates have multiple locations, multiple legal entities. They want to get a single view of that. Most importantly, from a payments and collection management perspective, the treasury center concept, which Varun also spoke about earlier, there's a lot of benefit that they're deriving there. So this is just simply from a pure treasury operations perspective, cost management, revenue leakage. That point of view, there's a huge load of benefit. And if you just start talking about working with banks, that is reducing the physical landscape of bank accounts, reducing the dependency on the bank for operational account management, any kind of inorganic growth like mergers and acquisitions. The impact of such mergers and acquisitions on the landscape of bank accounts is phenomenal. So I mean, I can continue talking all day about cost benefits to the corporate. Very, very significant areas of focus, and this is nothing to do with geographic preference. This is a concept or a cost reduction mechanism that's kind of a high demand for any country anywhere. And if you look at it from the bank perspective, for them, every physical bank account has a cost associated to it from a system standpoint, from a people, that is, operation standpoint. So the number of physical DDAs that they service literally multiplies the cost for them. So that is a big deal for these banks as well. So I'm seeing this happen all the time. So there's really no question about operational cost being a big driver for virtual account. And of course, there's always this whole thing about developing business value, developing capital and risk management value for banks as well, which obviously is a huge deal, right?
Very good. Listen, we deliberately timed this webinar to be suitable for both Europe, Middle East time zone, and also North America, well, South America time zone. And I've got a question which, Varun, I'll probably come to you first about that the transatlantic divide, or however you want to call it, which is, do we see the same level of understanding and need in North America, in the US in particular, for virtual accounts as compared to Europe? So I think, Varun, your perspective being in Europe, but for an American bank, I think, Michael, your perspective being in the US for a bank that has strong connections to Spain, and Bala, your perspective will all be interesting. So Varun, perhaps I could let you go first.
So I think in terms of if I were to answer your question in terms of kind of how familiar the market is in terms of virtual accounts and kind of what they are, how they work, and so on. So there is difference between the two regions, and there is certainly a transatlantic divide as you call it, Phil. But that's mostly down to history. Virtual accounts are they're an old concept for Europe. They've been around for a long time. They've been around for long enough to permeate kind of various segments. So down from kind of the largest multinationals, as I said kind of earlier, to even mid-level segments, clients, professional services, and so on. Over in the US, it's a new kind of concept, new entity. But that doesn't mean, however, that clients are not interested in it. So I think there is across various sectors and industries, I think there's a significant amount of interest in virtual accounts and kind of what they can do to a corporate's payments management, receivables management, cash, liquidity management, kind of all the whole gamut of managing their treasury and cash. So I think that interest is definitely there, and I think very as the adoption kind of starts gaining traction, especially because there's a lot of multinationals who are based in the US who have roots in Europe as well, who are familiar with those concepts and want to and are keen to actually set up similar structures and gain similar efficiency in the US. I think we'll get to that particular point soon where that transatlantic divide basically diminishes.
Michael?
Yeah, so I would certainly agree. I think the maturity that Barry mentioned, I think, gives Europe a little bit of a head start. But you hear the topic coming up more and more, I think led by some of those global players that have these structures elsewhere and say, wow, this is a really efficient way to manage my business. I need to create that adoption in the United States. I think that's, on one end of the spectrum. And then I think on the sort of other end of the spectrum, clients, again, we kind of reference this escrow example, is clients who are in that business see the need to be able to have more control over their accounts open and closed. Folks that deal with a high volume of accounts, that's also creating more interest around that space. And I think it's just a topic you're hearing more. I think last year at the AFP, there were probably maybe 2 or 3 sessions around virtual accounts. I think the year before, maybe there was 1. And I think, going forward, there are going to be several more because it's a topic that's gaining traction. Anytime you have an opportunity to introduce efficiency and control to the client, I think that's something people really gravitate toward.
Excellent, very, very insightful. I know that I sort of gave away some of my own views in the introduction in terms of the ability for virtual accounts to democratize banking and put power in the hands of the corporation. It could lead to the death of the cost center. It could lead to industry-specific products. There's a lot of material. I've got a question from a senior banker from a European bank, which I think is related and puts it very beautifully, which is, do you think cash management may be absorbed by virtual account management? Is it going to be subsumed into it? And if not, what is the future of cash management? So push this as far as it goes and see where that can take us. Michael, since you just finished up there, let's go back to you first.
Sure. So I think the idea of fully absorbed, we're kind of a few steps away from that for sure. But I think where there are opportunities for efficiency, I think you'll see that bubble up when you talk about sort of, zero balance accounts or, needed complex structures around sweeps. That should start to simplify a little bit and clients can leverage the virtual account structure to create that efficiency in their operations. And then I think that that will evolve some of the things they can get from their information reporting and insights that they get from a relationship. So that would be my initial view around it.
Alan?
So I have a view of this which actually is tied into my theory of the evolution of virtual accounts, which actually started about 15, 20 years back. It's actually been a slowly developing encompassing of cash management services used in virtual accounts, right? So what started as something that was created as a necessity for handling invoice intense businesses in Asia became conceptualized into an account structure, which we are now calling a virtual account. And then slowly spread its tentacles to Europe, where I think Varun mentioned earlier on as well about Nordic cash pooling and similar structures. So that kind of spread the wings into broader opportunities. So what's really happening now is innovation driven by necessity is what I think is happening right now. And that encompassment, or for the lack of a better term, that the ability to encompass virtual cash management with everything that is virtual account, I don't think that's far away. It'll be a slow evolution, but I think it'll happen eventually. So, in terms of managing corporate account structures, in terms of managing receivables and payables, in terms of managing liquidity structures, I think the opportunities are endless.
So, just want to slip in, there's a follow-up to the question on costs, which is from a senior banker of a Middle Eastern bank. Has this efficiency created and resulted in lower cost actually also resulted in a charging opportunity to the bank, i.e. cost? Do you want to just take that one, Alan?
Sure. See, if I look at it this way, there's some bit of a heartburn that a lot of banks have in terms of how do I develop a fee or a revenue structure using virtual account, because sometimes there's a potential thinking that this can cannibalize fees from physical account and cash pool that were traditionally being charged by banks. But what really happening is this is creating a framework that actually provides bank with a more exotic mechanism to do pricing. And in my view, some examples are, simply by virtue of providing an enterprise level pricing for something like virtual account, not as a transactional component, but more as a service, a white glove service to customers, giving a lot of self-service capability to them. That is actually changing the paradigm of fee revenue from a virtual account point of view. And simply a couple of conversations that I've had in North America where banks are talking about changing the paradigm around fees for receivables and payables management. Basically, what we used to know as payment transactional cost is now changing into let us do receivables management on behalf of your company, and we will charge you a more of a blanket pricing for it as opposed to the traditional pay by volume kind of a mechanism. So these are some of the paradigm shifts I'm seeing. I'm sure Michael, Varun, you have some perspective on that as well.
So yeah, I'd absolutely and wholeheartedly agree. So I think the concern which is posed in the question is a concern which is often quoted. I think the way to look at it is, I think virtual accounts on their own are standing on their own completely in a silo is not a revenue driver on its own. So you'd absolutely think, instead of 1,000 accounts, now I have one account. How can that actually help me from a revenue perspective? I think the way to really look at that is having a virtual account structure that works for corporate, for clients, actually improves your relationship with the clients. So instead of being a more transactional nature of relationship with clients, where you're basically working on highly commodified services. Instead, it kind of becomes a more solution-driven relationship, which is mutually beneficial both to the bank as well as the corporate. Because if the structure is such that it can actually allow the corporate to do and manage their payments, receivables, and the liquidity in the way that they want to, it would lead to a natural increase in payments flows. It would lead to a natural increase in volumes, and it would lead to higher revenue. So kind of that is how I think in all the various regions which have seen the history of virtual accounts has been seen. I mean, there's, Southeast Asia has had virtual accounts for a long time. Europe has had virtual accounts for a long time. On their own, banks have not, reduced their revenue lines per client in that sense. I think to your point, Bala, the way in which the revenue gets earned and priced, that they definitely might be a shift in that. How do you price your clients? Do you start offering Netflix like subscription services, which is just a band subscription where everything that falls in the virtual accounts in that band kind of gets charged in a similar way, or do you offer or do you price in a different way? So I think there will be a change in the way pricing gets done and charging gets done, but I think it need not necessarily, as long as the structure is such that it works for the client, the solution is such that it works for the client, I don't think it would lead to a fall in fee or in NII for the bank.
And Michael, your view, and anything to add?
So I certainly would agree, and I think part of it is from a bank's perspective is deployment strategy, right? So with existing accounts, as we talked about, there's some risk of cannibalization, and again, you have to have a thoughtful pricing structure around that to retain that revenue. But if there's a low adoption in the United States, there's a low adoption of virtual accounts. If you're a leader in that space, that's a big time acquisition tool. That's a lot of differentiation in a market that's not super differentiated right now. And the attraction of bringing on new clients to your platform, the ability to establish primacy with those clients, and the ability to be the lead bank and have the lead bank deposits, it's very attractive. So I think if you look at it as this explicit line item, it can be a little bit challenging, as everyone's sort of articulated. But if you look at it in sense of the overall relationship and your ability to acquire new relationships, I think it can be extremely accretive to what you're solving for as a U.S. bank.
And that can go way beyond just fee revenue, right, Michael? So
Absolutely.
Yeah, I agree.
We've got such a lot of questions, and I've tried to pick out the most common ones and the most interesting ones, but I think we're going to have to wrap up, I'm afraid. I'll do one last quick round with just short answers, a few seconds each, please, if we don't mind. I'll start with Varun, which is, this is an exciting topic, but I don't know how well understood it is at senior levels in organisations at the top level. How easy is it to put a business case together to improve the estate for virtual accounts? On a scale of 1 to 10, is it 1? Is it 10? Where is it?
I think the answer would be it depends. I think it mainly depends on what your sector is to which you want to pitch your virtual accounts and position it, and the kind of solution and the use cases that you want to address. And I think depending on what those are, and that combination is the one that actually makes it either very easy and very palatable, or a little bit harder to sell.
Okay. Very clever, very clever. Michael, and by the way, you keep guys agreeing. I want you guys to start disagreeing. It makes it
disagree. Well, you know what? It's hard to disagree with. It depends, right? Like that's a little bit challenging to disagree with. But what I would say is, I think if you have a specific segment that you're designing the case around, that you're trying to attract, say a deposit segment or a deposit rate segment that you believe this solution will help you attract, you can it's a little bit easier to construct a case. But I think generally it has the same challenges that real-time payments has as far as case goes. It's not in order to define it, it's a little bit tricky. You have some of the cannibalization issues that you're talking about. And I think that clients or banks that really are trying to position themselves for growth and leverage this as a growth tool have an easier time structuring a positive case for it.
Carla, last word to you.
Yeah, sure. So I mean, speaking to my consulting part of my life, one of the things our managing partners used to tell us was, when you're not sure about the answer, say it depends, right? So, always the case. But you know what? I have been personally very, very interested in this space, and I've seen a lot of bankers talk about business case for virtual accounts, and it's a new area, right? It's a very new area for them. They're also trying to figure this out. So what I'm seeing is, there are broadly four groups. For banks, what they're trying to do is they're truly seeing what is the business or revenue value for them. They're trying to look at, I think we spoke a lot about operational value a short while back. That's obviously reducing cost is a big deal. Capital and risk management value. I know we didn't talk a lot today about regulatory impact. Varun did highlight about increasing operational deposits, and basically Basel III creating the whole requirement for liquidity coverage and the capital adequacy. So we're seeing a lot of interest in banks looking at how to reduce that element and contribute to their business value. And if you take the sum total of all this and look at what does it mean from an increase of revenue opportunities, a decrease of operational costs, from a technology perspective, decrease in terms of systems by putting in more API driven and cloud implemented solutions, the whole cost associated with that. And last but not the least, from a people standpoint, how much more can you automate so that you can reduce the people impact and automate things to keep your cost low. So these are broad framework elements that and by the way, I'm not even talking about the benefits to corporate. That's a huge area in itself. So if you take all of these aspects and plan a scientific mechanism around it, I personally think it's very easy for banks to figure it out, to build a business case. I mean, I've been talking to a lot of my clients in North America exactly about this, and we've been providing guidance to these organizations, telling them this is how you can construct a business case for virtual accounts.
So yeah, any banks listening, just if you're not sure, ask Bala. Listen.
Oh my, sure.
Wednesdays with IGTB, yet again, it seems to me, delivering top quality discussion, debate, and insights from top people in the field. So do check out. We've got recordings of previous webinars on the website igtb.com/Wednesdays. The only difficult bit is making sure you spell Wednesdays correct, or just go to igtb.com. Click through, and thank you very much to Varun, to Bala, to Michael. Great comments. I wish we could go on longer. I know that we could. Thanks also to all the audience for joining, and thanks especially to those who asked questions. I'm sorry we didn't get to you all, but feel free to contact us, marketing@igtb.com. And we'll see you at another Wednesdays with IGTB soon.